The Federal Reserve, or the Fed, was established in 1913 to create a safer, more stable monetary and financial system. Before the Fed, the US experienced frequent bank runs and financial crises. The Federal Reserve Act, signed by President Woodrow Wilson, aimed to provide a flexible yet secure financial system. The Fed ensures macroeconomic stability and prevents banking collapses during downturns. It serves as the central bank of the US, managing the economy and setting monetary policy. The creation of the Fed was pivotal in US economic history, providing a central institution to manage monetary policy. Since then, the Fed has evolved, adapting to changes in the economic landscape. The structure of the Federal Reserve is complex, consisting of several key components. First is the Board of Governors in Washington, D.C., with 7 members appointed by the President. Members serve staggered 14-year terms to ensure stability. The board oversees the Federal Reserve System, shaping monetary policy and regulating banks. Second are the 12 regional reserve banks across major U.S. cities, implementing policies set by the board. Each bank monitors economic conditions and offers financial services in its district. Finally, the Federal Open Market Committee, FOMC, includes the Board of Governors and 5 regional reserve bank presidents. The FOMC meets regularly to decide on key interest rates and other monetary policies, significantly influencing the economy. The Federal Reserve has 4 main roles to ensure economic stability. The first role is monetary policy, controlling the money supply and interest rates. The second role is financial supervision, monitoring and regulating banks. The third role is providing financial services, serving as a bank for the US government. The fourth role is acting as the lender of last resort, providing emergency loans. By fulfilling these roles, the Fed helps maintain economic stability. The Federal Reserve uses several methods to implement monetary policy. One key method is open market operations, OMOs, buying and selling government securities to adjust the money supply. When the Fed buys securities, it increases the money supply and lowers interest rates. Conversely, selling securities decreases the money supply and raises interest rates. Another method is adjusting the discount rate, the interest rate charged to commercial banks for short-term loans. The third method is setting reserve requirements, the amount of funds banks must hold in reserve against deposits. These tools allow the Fed to manage economic activity effectively, influencing inflation, employment, and overall economic growth. The Federal Reserve impacts the economy by setting interest rates and controlling the money supply. Lower interest rates make borrowing cheaper, boosting economic growth and reducing unemployment. Raising interest rates helps control inflation. The Fed aims to keep inflation moderate to maintain purchasing power. The Fed's actions impact employment and economic stability. During downturns, the Fed may lower interest rates to stimulate the economy. The Federal Reserve is designed to be independent from political influence, crucial for unbiased economic decisions. The Board of Governors, with its staggered 14-year terms, ensures this independence. Board members cannot be easily removed by the President or Congress, focusing on long-term economic health. The Fed's funding structure supports its independence, funded through its own operations, not congressional appropriations. This financial independence allows the Fed to operate without political interference. The Fed's independence is vital for maintaining public trust and making decisions in the best interest of the economy. It ensures that monetary policy decisions are made based on economic data and long-term goals. The Federal Reserve plays a crucial role in the US economy, impacting interest rates, inflation, and employment. The interest rates it sets influence mortgages, car loans, and credit cards, affecting the cost of living. By controlling inflation, the Fed helps maintain the purchasing power of money, preserving savings, and ensuring economic stability. The Fed's efforts to promote employment create job opportunities and support economic growth. Understanding the Fed's role can help individuals make informed financial decisions. It is important for citizens to stay informed about the Fed's policies and their impact on the economy. This knowledge empowers people to advocate for policies that promote economic stability and growth. Stay informed, stay engaged, and understand how the Fed's actions affect you. If your bank account looks like a desert, you're a perfect fit for our channel. If you got value out of this video, don't keep it a secret. Hit that like button, share it with your friends, and subscribe to join our savvy squad. And remember, every click gets you closer to lounging like this octopus in a pool full of money and gold. So what are you waiting for? Click, share, subscribe, and let's get rich together!